It is down 40% year to date. It is pretty much towards its 52-week low and offers a yield of nearly 7%. So is UGI undervalued? We're going to run the numbers in our valuation model based on their latest earnings to get to our intrinsic value and our acceptable buy price. We're also going to take a look at the dividend safety, run it through some financial metrics, and also take a peek at whether institutions are buying or selling. Quite a few different things to uncover, as well as take a look at how their revenue, top line and bottom line has progressed given their latest earnings, and see whether or not they do have a safe balance sheet comparing their total debt to their total cash. A quick health check. Now, when we take a look at UGI, as we can see in the utility sector, a lot of companies haven't been performing the greatest this year. Now, when we look at the last 10 years, we do see it is down around 17%, with its all-time high sitting at the back end of December 2018, quite some time ago at $59. In fact, this stock would need to go up more than double to go over its all-time high. Are we going to see those levels for UGI Corporation? Let's take a look in today's episode, and let's start off with what the institutions have been doing. So we see around 82% institutional ownership, 876 million worth of sales by these institutions over the last 12 months, and we see slightly more at 1.16 billion of buys in the same period. Now, a few interesting things to note. Over the last 4 quarters, what we can see in Q3 this year, more buying than selling, 264 million worth of shares bought. Over the Q1 and Q2, in fact, we see the opposite. And in Q4 2022, we see a very large buy at just under $500 million. So yes, institutions are buying more than they are selling, although the majority of 2023 the institutions have been selling. But in the more recent period, that shift has changed and they have started to buy more than sell. So is this undervalued, and is it something we should start paying attention to? Now, top line revenue, we like to see 3 to 7% growth year on year, 7.3 billion in September 2019, and based on their latest earnings, 8.9 billion. So they have had growth over the last 5 years. But something to note on a more granular level, their top line did drop from 19 to 20 before picking up in 21 and then 22 before then dropping. So we do see the effects of the cyclicality on the industry, and we'll shortly touch upon the last 10 years percentage wise in terms of their growth. Now, in terms of the bottom line, how does that compare? What we can in fact see is that in September 2019, their bottom line has gone from 256 million to a net loss in September 2023 of 1.5 billion. Now, this is something that we have discussed in the previous episodes when running through UGI Corporation, but there were 2 reasons for this, with the largest ones effectively being their net losses on the commodity derivative instruments, as well as the other point here being essentially the loss associated with their impairment of AmeriGas propane goodwill. But if you want to see more of that, do go check out the previous UGI video where we do uncover this. But when we do remove this on an adjusted basis, they are increasing their bottom line. Now, 2019, as we see on a granular level, it does increase all the way to 2021 before decreasing as we see. So there are the cyclicality effects of the industry that you do need to consider before investing. Now, in terms of a quick health check, total cash versus total debt, 447 million of cash in September 2019. September 2023, we do see in actual fact it did drop. So they are holding on to slightly less cash than they did over the last 5 years. In terms of their total debt, numerically and directionally, we see it increased from around 6.6 billion to their latest quarterly report of 7.7 billion. So they do hold a significant amount of debt in comparison to their cash. And as we see, their cash decreases over the last 5 years, whereas their total debt in fact increases. And we'll touch upon that shortly when we look at that dividend safety and financial metrics. Now, in terms of how they've performed versus some well-known competitors in the gas utilities industry, we have National Fuel Gas Company, we have Brookfield Infrastructure, and we have a few others to note. Now, what we see with UGI, they are one of the worst performing, if not the worst performing in the industry, down 37%. Now, total return means including those dividends reinvested. But one thing to note, the industry as a whole has taken a hit, with the only company to be up from the competitors that we note today, SWX. Now, over the last 5 years, what story do we see? UGI down 50%, so very, very poor, and in fact the worst performing. And when we compare to the others, we do see a few more turning a positive figure. So something just to bear in mind, the cyclicality nature, but as well as the fact that some peers have performed significantly better, such as BIPC, and we see here NFG. So also note that past performance is never an indicator of the future. Now what we can take a look at is that dividend safety score. We see it at 60, so it is borderline safe. Market cap 4.8 billion, so it is a mid-cap company. Now in terms of recessionary metrics, they did in fact increase the dividend over the last recession 07-09. Negative 16% sales, so average growth during the S&P 500's growth period for the recessionary 07-09. But they did significantly outperform the S&P, negative 16%, versus the S&P's negative 55. Dividend growth, I would say pretty decent, a 4.2% increase in May 23. It is what I advocate on the channel, to at least keep up with inflation, which is around 4%. So if you are in fact increasing slightly higher than 4.4% in fact this year, you are also locking in a yield of around 6.6%. So that is pretty decent in my opinion. Over the last 5 years, 8%. Over the last 20 years, 7%. If you are able to lock in a yield of between 6 to 7%, and you are keeping up with inflation over a long period of time, you could consider that a pretty decent win. They are also a dividend aristocrat. They have been increasing their dividends for 25 years or more. And something incredible, they have been paying dividends for the last 139 years without a reduction. Now, dividend yield theory, for those that are new, states that the company is undervalued when the current yield sits above the 5-year average. 6.58 versus 3.58, we have our first sign of undervaluation. Bear in mind, though, we never look at any of these models in isolation, and we will draw our conclusions towards the end of the episode. Forward PE 7.9 versus 13.1, another sign of undervaluation. And we can see even in the utilities industry, it still has a much lower forward PE than that of the sector PE at 16.3. Now, when we compare it in terms of the free cash flow payout as well as the earnings payout, what we typically know, yes, most companies do prefer to look at the free cash flow, as earnings is susceptible to manipulation by management through accounting. But what we do see here is that effectively the utilities free cash flow payout is a lot more volatile. So earnings payout for utilities, we prefer this to be around 75% or less. And very, very notably, over the last 10 years, it has been, in fact, been lower than 50% on majority of the occasions. 2023 at 52%. So that is something I like to see, especially for a company that pays a fairly strong dividend yield. Earnings per share were $1.99 in 2014, $2.84 in 2023. It is increasing over the period, not as consistent as you may like, and not that it is a fast-growing company. But again, do bear in mind the type of companies you are investing in, and not to expect every company to be fast-growing unless you are looking at a particular set of companies. Sales growth, well, this pretty much here illustrates what I was saying earlier around the cyclicality of the industry. We have positive returns, in fact double digits, followed by double digit negative growth back to back, and so on and so on. So do bear in mind the cyclicality of this industry. And a tip would be essentially to always try and buy companies that are out of favor, and then run them into essentially when they are in favor and they are going up quite significantly. Try not to always buy companies that are cyclical right at the top when they are in fact in favor significantly. Total sales then, how does that look numerically for those that like to see the numbers? 8.3 billion in 2014, 9 billion in 2023. So we do see the peaks and troughs over the last 10 years. And one thing to note, they do effectively dilute your position as a shareholder. They have issued shares over the last 10 years from 175 million to 210. Although do note in 2022 to 23, they did buy back some shares, as we see that 6 million drop. Now, when we take a look at ROIC, now 10% typically or more gives me faith management are able to effectively allocate their capital. For utilities, we can go down to around 7.5%. Over the last 10 years, pretty strong, I would say, although do note, based on that net income that we did see that it was negative, we do see this negative 5% for 2023. Now, operating margin and free cash flow margin, well, what we can see is, yes, we like around 18%, but they have struggled to keep that continuity, which you could argue due to the cyclicality is a reason why we will not see that. And on the free cash flow margin, we don't typically look at this for utilities, so that does become redundant. Now, net debt to EBITDA, for those that are new, it signals two things. One, the safety of the dividend, and the other is the strength of the balance sheet. Now, below 5.5 is what we look for utilities. These signal the number of years it would take the company to pay off all of their debt net of cash on hand. What we see in 2023, 4.17, and in fact, for the majority of the last 10 years, below that 5.5. 2024 expect to be pretty much in line, so it gives me faith that that dividend for UGI is going to be safe for the time being, as well as the strength of the balance sheet. Now, in terms of the valuation and the numbers for UGI, we can run it through our valuation model. And as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And do click on that pinned comment below so you can grab a copy of the intrinsic value calculator to get to the acceptable buy price of companies on your watch list or in your own portfolio, given your own margin of safety. So let's jump straight into the Graham's valuation. Now, this is the model we typically use, and it is relevant for the utilities. We have this stock ticker symbol, the earnings per share, growth rate per analyst estimates, and that current yield on AAA corporate bonds. Now, the reason why we won't use this in today's episode is for the fact that the trailing 12 months for UGI Corporation is negative 7.16. We have used the 2022 figure here of 4.97. So for those that do want to include it in their own valuation, you can use the intrinsic value number here. But for us, for now on the episode, we will not be including this. And we'll also be excluding this from the multiples valuation model purely because this is based off the earnings per share from the previous slide. But typically, multiples valuation, we have the stock price, earnings per share, P multiples of companies in a similar sector and size. We have their average P and multiplied by the earnings per share. So if you also want to use that for this valuation, we have the number here. So the first one we're using is the dividend discount model. With the yearly dividends, we have the growth rate. Very nice to see. Average growth rate 7.92%. Now forward looking, I have gone a bit more conservative at 3.75%. A lot of people will argue that is too conservative, especially given the average growth rate. So if you do grab a copy of the model, you can play around with these figures. But based on that, it gives us a DDM price of $37. We can see that is some nice upside to the current trading price, around $23, slightly lower than the 52-week high, showing signs of undervaluation for UGI based on the DDM model. But as always, do bear in mind we never look at any of these models in isolation, and we will draw our conclusions towards the end of the episode. We then have the DCF model, the discounted cash flow model, where we have our free cash flows year on year. Average growth rate just under 6%, forward looking, gone a bit more conservative, in fact more conservative than analysts. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to get a DCF price of $36. Now when we take a look at that again, slightly lower than the 52-week high, but significantly higher than the current trading price, showing again signs of undervaluation, and some could argue this is towards the bottom of the cyclicality of the industry and the company. Now when we take a look at the intrinsic value, as always it is just the average of the models that we've run through, and in today's episode it will just be the DCF model as well as the DDM model. So the intrinsic value for UGI Corporation comes to $36.34. And as always, if you're enjoying the content and values being provided, smash that like button, hit the subscribe and bell button if you enjoy the content so you do have these videos drop to your doorstep. Margin of safety we typically start off with is 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. So it is a buy if you believe that up to $33. At 20% it's a buy up to $29, and at 30% it's a buy up to $25. So we can still see there is some significant margin of safety into UGI. So 40% is too high. So at 35% we see it is an acceptable buy up to $23.62. If you believe a margin of safety of 35% is appropriate. Again, this will be different for different investors. And if you do click on that pinned comment, you can play around with this model, not only for UGI, but also for other companies either you're interested in or in your portfolio. Now, what do Wall Street say? So they believe there to be some significant upside as well to the current trading price, at around 40% upside to the current value. So in terms of what we're saying in conclusion for UGI Corporation, we believe it to have a margin of safety based on our own estimates and judgments of 35%, whilst Wall Street see around 40% upside to the current trading price. So they do believe it to be a buy. As always, let me know your thoughts with UGI. Do you believe it is at that point in the cyclicality of the industry where it is becoming out of favour? We do see the price right there at that 52-week low. Or do you believe it has further to drop given the utility industry? Personally, this is one that I do believe to be a buy right now, and it is one I will start to potentially dollar cost average into depending on how next week goes. As always, let me know your thoughts in the comments below. Is this one you're looking to add? looking to sell, or maybe this is one you have held on to for a significant amount of time. If you've enjoyed today's episode, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And as always, catch you on the next episode and take care.